Okay, so we're starting the next topic, right? Chapter number 8. Like in the last class, we studied the previous part of the non-current assets. You remember that was basically acquisition and the depreciation part, right? So similarly, we are
Yeah.
starting the next topic, which is known as non-current assets, disposal and revaluation. So this has two additional topics, extra topics, which are namely disposal and revaluation. So first of all, we'll discuss the disposal, and secondly, I'll come towards the revaluation, because revaluation is mostly theoretical, right? And disposal is mostly, you can say, calculative part. Okay. Now, let's first discuss the theoretical knowledge from here, okay, regarding the disposals, because first we are
Yeah.
looking at disposals, okay. So,
Mm-hmm.
first of all, let's see. IS 16 says that carrying amount of an item of property, plant, and equipment shall be de-recognized on disposal or when no future economic benefits are expected from its use or disposal. Okay. So what's happening is that disposal means whenever we plan to sell off the asset, we don't need it anymore, right? So the same definition explains it over here in much formal words, that whenever a carrying amount of a property, plant, or equipment is recovered more majorly and mostly through the disposal, then it's very important to dispose of the asset, because obviously the asset probably does not have more amount of life left. So obviously we have to dispose it off so that we can, you can say, um, maintain the cash flow of the business. Okay, so that we don't run into efficiency losses. Okay, so when tangible non-current asset is disposed of or de-recognized, so these both things means the same: disposing of and de-recognizing. There are a number of
Mm-hmm.
adjustments required to remove the asset and associated accumulated depreciation. Obviously, first of all, we have to remove the asset that is in our books. And secondly, the depreciation that is charged till date. For example, let's say we have charged depreciation for 10 years, 15 years, 20 years. So all that depreciation, the total of it, we have to remove it as well. So we'll study the steps of how we remove it in just a short while. Okay. Now, the next thing you can see over here, profit or loss on disposal. So this is a very important table. Okay, you can make it in your notes as well, or you can take a screenshot as well. This will be very beneficial in the revision days as well. So what happens is that this is explaining you when we get a profit and when we get a loss. Okay, so there are two things. Always remember, there are two things that we need to compare, right? And obviously this is common sense as well. So two things that we compare are, firstly, proceeds. Proceeds means that how much cash we received after selling the asset, right? So for how much cash did the asset got sold out. And second is the carrying amount, right? The thing that we discussed in the last class. Carrying amount was basically the current assets valuation at the current date that we are making the financial statements on. Okay, so we have to compare two
Mm-hmm.
things: proceeds and carrying value. If the proceeds are greater than the carrying value, then obviously we've got a profit. So what's the reason for this?
Yeah.
The reason for this is that, look, carrying amount is basically the value that the machine or any asset is bringing towards the company, towards the business. Okay, the maximum
Yeah.
value of use that is bringing. But proceeds are the proceeds that we receive after selling, right? So obviously, if we are receiving more cash, the values in use is less, the cash that we received is more. So obviously there is a profit. Like, this clearly shows that the value, if we continue to use that machine or the asset, the value would be a lot less, and proceeds have recovered the profit from it. Okay, and the opposite things happens over here, that when the proceeds are less than the carrying amount at the disposal date, then there is a loss. Okay, so let's say the carrying
Okay.
was 10,000, right? And right now we have a lot of indicators that the life has completely ended. The machine is in a very bad condition. The machine is desperately in the need of sale right now, right? So that's why we have to sell it so that we maintain the profitability of the business. So let's say there is a carrying amount of 10,000, and we got a deal with a person and he's ready to purchase the machine for 20,000. Okay, so you can see there is a clearly a profit over here. If we continue to use the machine, we'll only get 10,000 of, you can say, value, right? Added value. But the thing is that if you're selling it for 20,000, we're getting 10,000 straight, $10,000 straight in profit, right? So the same thing is happening over here. Two things are compared: proceeds and carrying on, always. Okay, and this is a very rare scenario. If the proceeds are equal to the carrying amount, then there is neither a profit nor a loss. So it's kind of like break even. But this actually in practical life, it never actually really happens. In very rare scenarios, it happens. Okay. Majorly, there's either a profit or a loss. Okay. Now we're discussing the steps for the disposal. So disposals are basically of two types. Let me explain over here. Disposals are basically of two types. First of all, in which we receive cash. Okay, so first disposal is when we sell the asset and in return we simply get cash. Okay, and second type what we have is that when we are selling the asset and we are buying another asset out of it. So it means that we're exchanging the asset, and this word is called PEA, which is part exchange allowance. Let me write the full form over here. Part exchange allowance. Okay, so this is the more trickier one. We'll discuss this as well, and cash disposal we'll also discuss. So both of them have pretty much you can say similar steps to follow, but there is a little bit difference in between them. Let's first discuss the cash disposal steps to follow. Okay.
Sorry, could you please wait one moment because I received an email from work.
Yeah,
Sorry.
Sure.
Yeah. Sorry, Samer. What time are we going to finish this lesson?
We are going to finish it approximately. I'll try to finish it by 30 to 40 minutes because this topic is not much long. Is there any issue?
Yes, because I need to do something for work, but I can wait like for 30 minutes still.
Is it fine for 30 minutes? Is there no issue in that?
Yeah, it's fine.
Okay, sure. So I'll try my best to finish by 30 minutes.
Okay, thank you.
Okay, sure. So again, I was discussing that there were basically two methods for disposal. One was cash, one was part exchange.
Yeah.
Okay. So cash disposal has some separate steps that we're going to discuss right now. So first of all, what we do is that the first step in this is that we remove the asset from cost account. So usually what we do is that when we are buying an asset, what entry do? We do debit non-current asset, and credit we do cash, because cash is paid out and non-current asset is brought in the company, right? But in this scenario, now we are disposing it off. So first step is we need to take the asset out of the cost account. So what we do is that we just reverse the entry. We do credit non-current asset from the cost account. This can be called cost or non-current asset. It's the same thing. Okay. So credit non-current asset account, and debit what we do is a new account which is called disposal account, because all the working for the profit or loss is done in the disposal T account that I'm going to show you in a while as well. Okay. So debit disposal and credit non-current asset cost account. This is the first step. Now for the second step, what we do is that obviously we might have charged some depreciation over the years that the asset is used. So we have to take that out as well. Okay. So the second step is remove the accumulated depreciation of asset. Now remember, when we added accumulated depreciation, what entry did we make? We actually debit depreciation expense and we credit accumulated depreciation, right? And I also told you that accumulated depreciation is increased on credit side, right? So if it is increased on credit, we have to remove it now. So obviously we will debit it over here, debit accumulated depreciation, and obviously on the other side we'll credit disposal over here, because we'll take basically all the items of the disposal into a separate account, which is called the disposal account.
Okay,
Okay.
sorry. So why does it go into the disposal one?
Because we have to calculate the profit or the loss. Most of the questions in the exam kit as well will ask you regarding the disposal that please find either there is a profit or a loss in this transaction. So for that purpose, it's just a temporary entry. The disposal account does not remain forever. It's just for calculating the profit or loss. Okay.
Mm-hmm.
Right. So third step,
That's because we have debited the disposal account in the first step.
yes, exactly. The first step is debit disposal and credit non-current asset cost account. So when we finish, there are like 4 or 5 steps in this. When we finish all the steps, you'll automatically get to know why we are costing in the disposal account. Okay. So the third entry is when we sell the asset. Now we have removed the asset, we have removed the depreciation. The third step is to record the cash proceeds. So record the cash proceed. So the cash that we received against the asset, we have to record that at this step. So what we do is debit cash because we are receiving cash, right? And credit we do disposal. Disposal account is credit over here. Okay, so 3 steps are done. Let's discuss the fourth one over here. So fourth and the last step over here is that finally we have to calculate either a profit or loss. So it can be one thing, either profit or a loss. And that step I'll explain you when I make the disposal T account. Okay. So over here, I'm making a T account. It's also made in the book. So it's the same thing. So this is disposal. So I am going to label them as well. There are step 1, step 2, step 3, and step 4, so that you can counter check it from the as well. So first of all, what we do, we remove the asset, right? So we do a debit entry in the disposal and a credit to the non-current asset. So what we do is that asset we remove from the disposal account. So we do debit disposal. Okay, this is basically step 1. I'm writing 1 over here. Okay, and the second step, you remember, we remove the accumulated depreciation. What was the entry? Debit accumulated depreciation and credit disposal. Exactly.
Yeah.
So credit we do disposal and we write over here accumulated depreciation. So that the reference, we just remember that this is the correct entry. On the third step, we just record the cash proceeds. So again, we are writing the proceeds over here as a credit in the disposal because the cash account is debited. So disposal is credit. So these are the 3 things that we write. This is the second and this is the third step. And finally, in the fourth step, what we have to do, we have to simply balance off the account. Okay. So the same step that we followed, what happens is that if you get a profit, it will come over here. Just a second, let me confirm this. 1 second. Yes, so the profit, if we have got, it comes over here on this side, and if there is a loss, then it comes on this side. Okay, and this is basically the explanation of step number 4. So either there is a profit, either there is a loss. This is basically a balancing figure. Okay, either you can get a profit or either you can get a loss. So we'll do some questions from the kit as well, maybe in today's class, maybe in tomorrow's class, in the next class. So you'll get what the disposal T account actually means. Okay, so these are the only 4 steps that are available in this disposal that we have to do. Okay, and now let's move on to the next part, the next topic. Okay, and we'll keep this class to just that next topic, and after that we'll continue on Friday. Okay.
Okay.
So just a minute. Okay, so first type of disposal we have discussed, this was basically the cash disposal. The second disposal that we're discussing it, part exchange allowance. Okay, so this is part exchange allowance. So what happens is that in the first part of disposal, the first type of disposal, we were just literally receiving the cash, right? But in this one, what we're doing is that we're just exchanging, we're not receiving any cash. We're just exchanging the asset. Okay, so always remember the first and the second steps are same as above. Let me write them as well. Again, remove asset, and second one was remove accumulated depreciation. So first two steps are same from above.
Yeah.
The only change is in step 3, 4, and 5. Let's look at this. So step 3 basically has one extra thing. Uh, right in this one, in the step 3, what we were doing, we were recording the cash proceeds, right? But over here, we're not receiving any cash. So what we're doing is that we are just basically replicating it as a part exchange allowance, the PEA that we're studying. Okay. So record old asset proceeds as part exchange allowance. Okay, so actually we're not getting any cash. So what we do is that we just record the old asset proceeds that are agreed with the customer that's purchasing. Okay, so let's draw an example over here as well. For example, this is a mobile phone. Okay, this is an old mobile phone, so I have to sell it. Okay, I go to the shopkeeper and he gives me a price of, for example, 20,000. Okay, this is just an example, so let's discuss this. So $20,000, or let's say 20,000 rupees, which is the currency over here. So 20,000 rupees, he's agreeing to take it, right? But he's not saying that I'll give you 20,000 cash. I actually communicated him beforehand that I have to exchange my mobile phone. I have to give my old one and purchase a new one. Okay, so this 20,000 rupees is basically the part exchange allowance amount, which is of this old phone. This is the old one. Okay, now I'm buying a new one as well. Let's say the new one costs 30,000. Okay, so what I'll have to do is that on one hand I'll sell the 20,000 mobile phone, right? And on the other hand I'll buy the new phone which costs 30,000, right? So obviously I'll have to pay some cash difference as well, right? And how much will be the cash difference? That will be 10,000, right? So again, repeating, I was selling my old phone for 20,000. I got the new one for 30,000. So obviously I'll have to pay some cash difference as well, right? But what happens is that this is the explanation of step 3. Whenever I tell to, for example, I bought a new phone for 30,000, I'll tell a lot of my friends and my family, right? Now, what do I tell them? Did I buy it for 10,000 or did I buy it for 30,000? So I will tell them I bought it for 30,000 because it's this price, right? It's original price. I can't say to them that I bought it for 10,000. That is just the extra price that I paid. This 20,000 is some significant amount as well, right? So this is the thing over here that we need to apply in step 3. Okay.
Yeah.
So what we're doing is that we are crediting the disposal account same as above. You can see credit disposal, which is this proceeds, this one. Okay, but we're not debiting cash over here. We're not debiting cash because we're not receiving cash. So what we do is we debit an account which is called new non-current asset. And basically what's happening is, you can see it's a basic logic that if I'm paying 10,000 extra for a 30,000 rupees mobile phone, this 20,000 is basically contributing as well to my new phone, right? Because maybe 20,000 he allowed it as a discount, or first give me the cash and then I added from my own pocket 10,000, then it became 30, right? So this 20,000 also basically has a contribution towards, one second, towards the new non-current asset, right? So this is the thing that we are applying in step number 3. We are not receiving any cash. We are just debiting the new non-current asset account with the old proceeds that are agreed with the shopkeeper. Okay, so what we'll do is,
We are creating the disposals. Why?
I'm sorry, please speak again.
Why are we crediting the disposal account?
Because for the disposal account, it's the same as treated as proceeds, right? For disposal account, it is a proceed, but it's recorded as a part exchange allowance. In return, we have not received cash. You can see in the step 3, it's the same entry, but instead of debiting cash, I have debited the new non-current asset account. Because why have I debited new non-current asset account? Because this 20,000 rupees is contributing towards it, right? This is not the cash that I received. It's contributing towards the new non-current asset. So this is the reason why I'm paying 10,000 rupees extra. right?
Okay.
If 20,000 was not contributing towards a new non-current asset, then I would have paid whole 30,000 amount from my own pocket, right? So
Mhm.
this is the explanation over here. That's why
And where does the difference go?
the difference I'll explain in step number 4. That's step number 4
Okay.
for that. So what we do in step 4 is that the remaining difference that we pay, we record the extra cash paid. Okay, and what entry do we do? This is a bit unattached with the disposal account, but still it's part of the sequence. Okay, so what we do is that we credit cash and we debit the new non-current asset. Now the amount will be 10,000 over here. So 10,000 and 10,000. So now if we look at it overall, the new non-current asset first got debited with 20,000 and now it got debited with 10,000 extra. So in total it became 30,000, right? So the same thing it's happening. It basically means that when we see the non-current asset at the end of the year, it will still lie at 30,000 rupees. Okay, so this is the step 4. Again, this does not have any connection with the disposal. It's just a continuation of the sequence. And finally, in step 5, we have to calculate the profit or loss, like same we did in the last type of the cash disposal. Okay, so again the same account is over here. There is no difference at all over here. Only remember there is one difference. Step 1 and step 2 are the same. We have to remove the asset, remove the accumulated depreciation. The third step is that instead of receiving the cash, the old asset proceeds are called the part exchange allowance. Let me write a note over here as well so that it's easier to revise. The note is old asset proceeds are called part exchange allowance. Okay, so the word PEA, whenever it's asking the exam, it always means the old asset proceeds. Always remember, and this will be given to you in the questions. We'll probably solve these questions as well, but probably in the next class. So what we do is that again in the step 5 we calculate profit or loss, right? And this is basically the small sketch that I explained you. This sketch explains it how the part exchange allowance parts work. Okay, right? So the question part obviously we'll discuss in the next class because I think you have some work to do as well right now. And what we do is that I think today's class is enough for now. And what I do is I'll send you these notes as well on WhatsApp. And the test I am postponing, let's do it. If you're free tomorrow, can we do it tomorrow? If you're free at the same time?
Tomorrow I can't.
Okay.
And tomorrow is Tuesday, right? Can we do Wednesday? Because I can
Okay.
on Thursday, if it is
Uh,
okay.
Wednesday is good for you?
Thursday.
Okay, Thursday. Yeah, sure. Thursday we can do, right? And what we'll do is that I'll send you the test on Thursday. Again, the class I'll confirm about Friday's class, if it's there or not. But the next class we'll be discussing the questions of this exam kit questions and also the revaluation part, because we've only done one part of this disposal one. One part is remaining, which is revaluation. It is mostly theory, but we'll discuss it in the next class along with the questions. Okay, right?
Okay, that's fine. So, are we